So what is the time now in UK? Aryans?
Sir, it's 3:58 a.m.
Early morning 3:58.
Yes, sir.
Okay. Mhm. Okay, keeping the objectives in the mind, the Reserve Bank of India has certain functions. All of you know these functions, so I will just brush up these things, then you can move towards the other kind of issues what we have planned to discuss today. So the first and foremost importance or the functions of RBI is RBI is the note issuing authority. All those notes and all these things are issued by the Reserve Bank of India only. So at present, all those notes or the coins like rupees 5, 10, 20, 50, 100, 500, 2000, these are issued by RBI. So who issued this 1 rupee coins? Yes,
So the government.
Central government.
it is yes, it is issued by, it is generally issued by the finance ministry or the central government directly. And apart from this 1 rupee coin, the other kind of denominations are mostly issued by the Reserve Bank of India. Second thing is Reserve Bank of India is called as the government banker because any kind of loans, any kind of deposit activities, so all type of payments and as well as the collections on behalf of the government, these are all basically managed by the Reserve Bank of India. It provides all type of services with respect to banking directly to the government. So government does not have to rely upon the central commercial banks for their banking activities. So on behalf of the government, they basically is involved in terms of transfer of the funds, management of the public debt, making payments, giving loans, and all type of banking activities which is required by the central government or the state government. These are all basically always managed through the Reserve Bank of India. So that's why we call that Reserve Bank of India is the bank for the government only. Then other thing is that one point we have discussed that is the management of the public debt. What do you mean by this? Whenever we talk about the public debt, Reserve Bank of India basically issues the new loans on behalf of the central and state governments. Okay, any kind of loan which is required by the central bank or the state government, these are all basically raised through this central bank. So any kind of loan activities which is raised from the public or any kind of management with respect to the debt which is used by the government, that basically managed by the Reserve Bank of India only. So that's why Reserve Bank of India has a different division which is called the public debt division. So all type of bonds and all these things which are issued, that basically always managed through that particular system. So that is basically, we call it that one of the major thing what Reserve Bank of India always does. So that's why you call it the Reserve Bank of India manages this public debt system within this country. Then another thing of the Reserve Bank of India is that they are also called the bankers bank. The bank basically controls the volume of reserves of the commercial banks because there is a cash reserve ratio and other type of concepts. So that's why it basically determines the deposit and credit creating ability of the banks, how much loan the bank can give, and to which sector the banks are giving the loan. And if the bank needs any kind of money, they also can always borrow this money from the Reserve Bank of India. So that's why every bank has the account with the Reserve Bank of India, and through that particular account, all type of lending, borrowing activities always happen. And if the banks also rely upon the other banks and they want to borrow some money or they want to lend some money to the other banks, that also can be carried out through this particular account what they maintain with the RBI. Generally, all those interbanking transactions are done through the RTGS, what we call it the real-time gross settlement system. So this RTGS system basically facilitates these commercial banks to transact with other fellow banks which are operating in that particular system. So as a part of the CRR, cash reserve ratio, the banks basically hold part or some of the reserves with the RBI. And at the times of requirement, the bank can borrow the funds from the RBI. So the lending and as well as the borrowing activities and the deposit activities, these are all basically done through this Reserve Bank of India only. Because all those transactions in terms of banking for the commercial banks are done through RBI or central bank, we call it they are the bankers' bank. Okay. Then one of the most important activity what the Reserve Bank of India does, they basically does the supervising. They are called the supervising authority. Supervision of the commercial banks are done through the Reserve Bank of India only. And what are those things comes under the supervising aspects? They issue license for new banks. Recently, you might have heard, not recently, some years back, there are many new banks have been created and new licenses have been given to some of the new banks to start their banking operations in India. So these are all done through, whole process is basically always done through this Reserve Bank of India only. They also issue licenses for setting up bank branches. If any bank wants to have a new branch, so then also for that also Reserve Bank of India gives them license to set up the new branches. Time to time, they provide the guidelines to maintain how much equity they should keep, how much reserves they should keep, how much cash reserve ratio they have to maintain, and all type of activities are directly controlled by the Reserve Bank of India for a better and sound financial system, or particularly the banking system. They also regulate the banks which are basically working in India and as well as abroad in terms of their organizational setup, branch expansion, mobilization of the deposits, investments, portfolio management, then manpower planning, training, all kind of things are basically controlled by them. Who will be the CEO of the bank? That also has to be approved by the Reserve Bank of India. Whether it is a public sector bank or private sector bank, that does not matter, but that has to be always approved. They conduct the investigation from time to time. If you have any kind of grievances against any kind of banks for any specific services or default of the services, then that grievances also will be addressed by the RBI only. So any kind of frauds, recently you might have heard there are certain frauds which have taken place in banks in India. That also will be the investigations and other aspects will be always conducted by the Reserve Bank of India only. So that's why Reserve Bank of India is the supervising authority for the commercial banks. And if there is any kind of merger and kind of activity takes place, any 2-3 banks has merged into one bank, which is recently has happened with respect to public sector bank. Also, it is although it is controlled by or it is regulation is basically the direction is coming from the central government, but the activities and all kind of mergers which are taking place, that operations, that kind of operational activities that will be controlled by the RBI only. So RBI will ensure that this kind of activities is happening in a better way, or in an effective way, or in a transparent way. So that thing is also controlled by the Reserve Bank of India only. So that's why Reserve Bank of India is a super regulatory body for the commercial banks which are operating in the Indian market. Then we have the most important thing which is not in the control of anybody in India, that is the Exchange Control Authority. You might have always observed that whenever you go for any foreign exchange transactions, the foreign exchange transactions is not a regular transactions what the bank do directly. They always have to do it through RBI only. So the total administration or the total regulating authority of the foreign exchange is always with the central bank or the Reserve Bank of India with reference to Indian market. They are basically the authority to choose the exchange rate systems, and they also manage these reserves, foreign exchange reserves. India has is one of the countries which has very high amount of foreign exchange reserves. And what are the different sources of the foreign exchange reserves and how the foreign exchange reserves can be managed? So all these things are basically always controlled by the RBI. We'll discuss more about the foreign exchange reserves and all these things whenever you go to the foreign exchange market. But you just simply now remember that all kind of operations or all kind of activities with respect to the foreign exchange reserve are managed by the Reserve Bank of India only. So this is the only organization which basically interacts and negotiates with all those international monetary authorities like IMF, World Bank, Asian Development Bank, and all. And if any kind of transactions takes place between India with other countries, so that always is generally done through the RBI only. So that is basically another major objective what the Reserve Bank of India always has, or major functions what the Reserve Bank of India always do. So there are certain differences in terms of objectives and functions. So objectives is basically the broad objectives. What is the basic motto of the Reserve Bank of India? What the functions is what basically the Reserve Bank of India does. What are those different activities they carry out? And which are the things which are in the control of the Reserve Bank of India? So these are basically comes under the functions. So that is the another important issue about the exchange control that you can always keep in the mind. They make the norms, prudential norms for the banks particularly, rules and regulations. They formulate the different type of norms to create and maintain a stable, efficient, and well-functioning financial system in India. For example, how much credit risk the bank can follow, how much capital adequacy ratio the bank should maintain. All kinds of norms or regulations are always coming from RBI. RBI provides time to time, they provide the guidelines, they provide the circulars to all the commercial banks. So these are the things has to be maintained. So why these things are important? These things are important because maintenance of those kind of indicators will basically facilitate a better sound financial system in India, which are less prone to any kind of failure in the future. Then another function, you have the promoter of the financial system that already I told you. They provide different developmental and promotional services, mobilize the savings, provides the concessional loans to the various priority sector. They instruct the banks, like that's why we have a priority sector lending process, priority sector lending activities. Out of the total money what the banks have, they have to provide certain percentage to the different priority sector like agriculture, like your small scale industries and all. And they have also some specific institutions like NABARD, they set up the specific institutions like NABARD, which basically is a facilitator for developing the agricultural sector, for improvement of the agricultural sector, which is the we consider as the one of the major sectors in Indian context. So that's why they are basically promoting the financial system. For better financial system, they always work. They also make regulations in terms of the payment system. Okay. So we have a system called negotiated dealing system, where this particular system basically helps us for trading these government securities. When RBI issues the bonds and all these things, and these bonds and the government's debts and all these things are always traded through the negotiated dealing system. Okay. And always they want to integrate the payment system with the settlement system for government securities and the foreign exchange. So that also they always try to make. There are different steps basically they take. By that, the proper integration can take place, and this proper integration will help us a better financial system within this particular economy. And the most important thing is they are basically the responsible for formulating and conducting the monetary policy. There are two types of policies broadly, or three types of policy, what we can say. But in the true sense, if you see, one is a monetary policy, other one is a fiscal policy. Although there are other policies like exchange rate policy, like your foreign capital policies related to FDI, policies related to FII. There are different other type of sub policies, but broadly, if you see that we have broad policies are like fiscal policy and monetary policy. And fiscal policy is completely controlled by the government, directly by the central government. And the monetary policy or monetary control is completely in the hand of the Reserve Bank of India or the central bank. So all type of activities with respect to the conduct of monetary policy is always done through the Reserve Bank of India only. So that's why we call them, they are the only regulator of money and credit within this particular system. So the money supply is completely controlled by this Reserve Bank of India by setting certain kind of or by using certain kind of instruments within the system. So overall, what we can say that the monetary control is with the RBI. Then you have the all type of supervising activity, providing the facilities, all type of banking facilities to the banks and other kind of governments like central government and state government. Then we have also seen that they are the sole controller of the foreign exchange, and finally they also provide the they are considered as the note issuing authority. So these are the major functions what the Reserve Bank of India always has, and this is the way this particular central bank functions within this economy. So if now we say that formulation and conduct of the monetary policy is one of the major function of the Reserve Bank of India. And why you are giving so much importance to the monetary policy? What is the basic objective of the monetary policy? Why the monetary policy should be formulated in such a way, or why the conduct of monetary policy should be always given importance? That is basically a matter of concern. So whenever we talk about the objectives, the major objective of the monetary policy is to accelerate the economic development and to maintain the price stability. Okay. Or overall, what we can say, the financial market stability also can be maintained. So controlling inflation, increasing growth rate, and stability of the financial market. These are the three major objectives what the monetary policy has. So that's why the functioning and the conduct of monetary policy is quite important. The function and the conduct of monetary policy is quite important. The reason is that these things have a direct link to the different other macroeconomic indicators like growth rate, inflation, and this market stability. So always the Reserve Bank of India makes the policy in such a way by that those kind of things can be in control. So for that, generally what happens that the Reserve Bank of India always try to what we can say the control the money supply. The Reserve Bank of India will try to control the money supply or always try to maintain the money supply in such a way by that the growth and inflation will be within the range, within the control. Because the relationship between inflation and growth is, what is the relationship between growth rate and inflation? Yes. If you increase the money supply, okay, go ahead.
Both of them are inverse to each other, means increasing inflation will reduce the growth rate.
Increase in inflation will reduce the growth rate. Lakshya?
Sir, if there is
Let
inflation,
us
so
start with this. If you increase the money supply, then it will increase the growth rate or it will decrease the growth rate. If money supply will be more, then the growth rate will increase or growth rate will decrease.
it will start and it will eventually increase with money
Growth
supply.
rate will, inflation will increase.
If the resources are fully used or utilized, then inflation will increase if money supply is in excess.
Let you assume that there is these resources are not fully utilized. There is unemployment. There is
Then
unemployment. Then in that case, if you increase the growth rate, then it will increase the money supply. Then it will increase the growth rate or decrease the growth rate.
Sir, are we talking about growth rate of GDP?
Yeah, growth rate of GDP.
So with the increase in inflation in the nominal terms, GDP will also increase.
I'm not talking about inflation. I just asked that if you increase the money supply, then what is the impact of that increase in money supply on the growth rate of GDP? Money supply, if you increase, then what is the expected impact on the GDP? Why we increase the money supply? To increase the growth rate or to decrease the growth rate?
To increase the growth rate.
to increase.
To increase the growth rate. So if you increase the money supply, then we are assuming that if there is some kind of unemployment is happening, resources are not fully utilized, then that increase in the money supply will lead to more investments. If more investments will be there, then the growth rate will increase. At the same time, what will happen to the inflation?
Will increase.
Inflation will
Increase.
increase. Am I right? Yes or no? Priyansa?
Yes, sir.
Increase the money
Yes, sir.
supply,
Inflation will increase.
inflation will increase. So if you increase your money supply, then your growth rate will increase, then inflation also will increase. So is it advisable to increase the money supply regularly?
No, sir.
Why?
Combination of fiscal and monetary policy should be
Then I
used.
forget about fiscal policy. We are not talking, fiscal policy is not the responsibility of the monetary authority. I'm talking
Yes,
about
sir.
the monetary policy only. So if we are keeping our fiscal policy issues remain constant, then if you increase the money supply, then your growth rate will increase and the inflation
Yes.
also will increase. So is it advisable to increase the money supply regularly?
No,
Yes
sir.
or no?
No, sir.
Why?
Sir, because inflation will lead to unemployment.
Inflation will lead to unemployment. Okay, that's fine. Anything else?
The devaluation of currency will take place as more and more money will be printed.
No, I'm not talking about printing rate. Money supply can be increased in various ways. Anyway, what basically here we are
That the
talking
effect
about,
only will be on nominal GDP
yeah,
rather than real
nominal
GDP.
GDP, nominal GDP will increase, but your real GDP will go down. Yes or no?
Yes, sir, that's what I had the doubt. Like, even if we increase the like money supply, then inflation will increase, so prices will go up, so income will go down. Then how is growth rate going up?
And we are talking about the nominal growth rate,
Okay, sir.
right?
So, but that is not like the correct measure.
Nominal growth rate, the nominal growth rate will increase, but one thing you remember that increase in the growth rate, increase in the price stability or increase in the inflation. The relative increase of the price and the relative increase of the growth rate, that will decide whether effectively your real growth rate will be increasing or decreasing. Yes or no? Priyansa?
Yes, sir.
That due to the increased money supply, your growth rate has increased by 10% and your inflation has increased by 5%. So the real growth rate has not increased relatively. Yes or no?
Yes,
Hmm?
sir, increase.
So the concern here is that what is the relative increase? But the question here is that whether increase and decrease in money supply, is it directly controlled by RBI? Is RBI is really competent enough to control the money supply completely? If RBI wants that, okay, in the economy, I want 500 crores should be circulated. Tomorrow they want that 550 crores should be circulated. Is it possible for RBI to exactly control the money supply in the system, which is there in the hand of RBI? Yes or no? So let me ask you a straight question. In this context, if I put this question to you, whether money supply is exogenously determined or endogenously determined. You know what do you mean by exogenous and endogenous? Yes.
Yes, sir.
So money supply is exogenously determined or endogenously determined? Or if I say, is it really the complete control of the money supply is there with the RBI, or the complete control is not there? The control of the money supply depends upon something else. Yes, Priyansa, you want to tell something?
Sir, I think complete control is not there, but
Why?
I
You are
don't
right.
believe
Why?
it is.
Why it is not there? Hmm?
So they also have to keep in mind the demand for money. Like they can't keep on increasing or decreasing money supply on their own.
That is okay. That is fine. That there are other factors, but directly also, if you see that all the money which is flown to the economy or the money which is utilized for the economy, that is also not in the control of RBI. Why, you see? So the money supply cannot be the only control variable of monetary policy. So it is not exogenous because it is not basically fully under their control. So there are two major factors apart from the other market related factors what you are talking about. There are two visible elements which are completely or virtually outside this Reserve Bank of India's control. One is the increase in the money supply with respect to the inward remittances of the foreign exchange. How much foreign exchange in a particular period will come to India, that is not known to us. That is also not predicted by RBI beforehand. Number one. Number two, the requirement of the credit for financing the purchase of the food grains. How much loan is required to buy the food grains, which is generally demanded by the public. So the question here is that the demand for the food grains or the purchase of the food grains depends upon the other external factors like monsoon and other things. So if the public needs more money to buy the food grains because of certain natural calamity, then the loans and all these things which are required to buy those food grains from the other countries, from other sources, are not in the control of RBI. So these are the two visible factors or visible elements which first deny the exogenity of the money supply. So directly this money supply cannot be controlled by RBI completely. The direct control of the money supply is not possible due to these factors. And apart from this, there are other market related factors with respect to demand and supply and all these things. So therefore, the Keynesian concept of exogenity of the money supply is not true in the practical sense. So that's why the money supply is always controlled by certain factors. If the money supply is controlled by certain factors or certain kind of other instruments, then the whole process of the monetary policy basically works in this way. There are certain instruments what the RBI uses to control the money supply, and those uses have the impact on the intermediate targets. They have certain intermediate targets, and once this intermediate targets gets affected, then finally your total output will be getting affected. So the question here is that there are certain instruments, there are certain targets, particularly the intermediate targets. And if you see, what is the intermediate target? The intermediate target is the money supply and the volume of the bank credit. These are linked again. So RBI will change certain things, and that change will have the impact on the bank loans or the aggregate money supply within the system. And once this bank loan and aggregate money supply within the systems gets affected, then that will have the impact on investment and other things. Then finally your output will be getting affected. So that is called the monetary transmission mechanism. That is called the monetary transmission mechanism. So the monetary transmission mechanism is very much important, and how basically money is transferred to different kind of sources or different kind of how this instrument is getting transferred to different kind of other activities within the system. So that is basically the most important thing for the effectiveness of the monetary policy within the system. So here, whenever you talk about this, so that's why there are three phases, what we can say. So these three phases are basically always work whenever you talk about the effectiveness of the monetary policy within the system. So whenever you talk about this, whenever we talk about the kind of process of the monetary policy, always you keep in the certain things in the mind. So the first thing, basically what we call it, we have to make certain changes, certain instruments we have to use. By that, it will have impact on the intermediate targets. And once the intermediate targets gets affected, then your other process like investment and all these things gets affected. So if the investment and other things gets affected, then output gets affected. Now you tell me, which are those instruments of the monetary policy you might have already studied? Let me only ask you, what are those instruments of the monetary policy? Yes? Who can tell?
So can you repeat the question?
What are those instruments of the monetary policy?
Sir, government funding policy.
What do you mean by that, Ray?
So like how much amount is the government infusing into the system?
Government cannot infuse the money to the system. This is all done through the RBI only. But how the RBI can control the money supply? What are those kind of instruments the
Sir,
RBI
it
should use?
changes
So
cash
bank
reserve
rates.
for bank
Huh? Yes,
repo rate.
repo rate. Fine. What else?
Cash reserve ratio.
Cash reserve ratio. Okay. What else? Priyanka, you were telling some point?
The statutory liquidity ratio
SLR.
and
Okay.
reserve repo rate.
Okay. Reserve repo rate, CRR,
Bank
SLR,
rate,
bank rate. Okay. Oh, what else?
cash reserve ratio.
No, तो already हो गया, CRR हो गया. What else? What are the others? No? Khatam?
Sir, reverse repo rate.
This is also over. What are the others? One particular major point you are forgetting. You said some of the things, major things you have told, but one of the things, important things you have not told. What is that?
Open market
Sir,
operations.
open market operation.
Open market operations. Okay, good. Now you tell me how these instruments is helping to control the money supply. Let me take you first. We can start with this open market operation. What is open market operation? Tell me.
So it refers to the sale and purchase of security in the money market by the central bank of country.
By the central bank of the country. So when the central bank will buy the security, when the central bank will sell the security? It is a buying and selling of the government securities in the market. That is good. That's fine. But at what time they will buy and what time they will sell?
Sir, when the liquidity
Sir,
is
when
low,
the price
then
starts,
sir,
To increase the money supply, they will buy or sell.
Buy, sir.
They will buy. To increase the money supply, they will buy. If they will buy, then what will happen? They will buy the government bonds. So that's why the money will basically be flown to the system. Then that will increase the money supply. Are you saying like this?
Yes, sir.
Okay. So whenever they will sell, then what will happen? They will extract the money from the market.
price
Yes? क्या बोल रहे हो?
Like, sir, the when the price will rise, then, sir, the central bank will sell security.
So the price is rise means the money supply is high. So because of that, there is a price rise. So that's why they want to reduce the money supply. So to reduce the money supply, what they will do? They will sell the security. That's what you said, na?
Yes, sir.
So
Yes, sir.
if they will sell the security, what they will in that process, what will happen? These securities will be basically bought by us or bought by these financial institutions, and then automatically what will happen, that they will basically extract the money from the market. So by that, overall the money supply can be reduced. So the reverse thing can happen whenever they want to increase the money supply. If they will want to increase the money supply, what they will do, they basically can go for the purchasing the security from you. So that's why the money supply can be flown into the system. Okay. So in that process, the money supply gets affected. Then another point you told, what is bank rate? Priyansa was using this particular. Or anybody can say? Yes.
Sir, the interest rate at which RBI lends long-term loans to other banks.
Long-term loans to the other banks. Good. So the bank rate is basically the rate at which the central bank basically provides the loan to the other commercial banks, and generally the bank rate is a long-term rate. Correct. So if the bank rate will increase, then it will increase the money supply or decrease the money supply?
Decrease.
It will decrease the money supply. Why?
Sir, it will be difficult for the commercial banks to take loans from RBI, and that in turn will decrease the money supply.
And other points. This is one point. Other point. Can you tell with respect to that? Can you tell anything else? Can you elaborate? One thing you said, that if the bank rate is higher, then the demand for loans from the commercial banks will be declining. So that's why the banks will not be able to give more loans to the public. That's why it will reduce the money supply. In relation to this, can you little bit elaborate that
Sir,
also?
bank rate increase in bank rate will lead to increase in the interest rate of the commercial
Yes.
banks.
Yes. Then the
And
demand for loan will go down.
yes,
Right?
sir.
Yeah. So one thing is increase in the interest rate will basically increase this in terms of bank rate, will go for the increase in the loan rates or the lending rates of the commercial banks. If the lending rates will be more, then what will basically happen? That will automatically reduce the demand for loans for the banks. Then in general, the aggregate money supply in the economy will be reducing. Okay, another instrument is CRR, cash reserve ratio. If the cash reserve ratio will increase, then how it will affect money supply?
So it will reduce the money supply because banks will have to keep money with them.
थोड़ा जोर से बोलो रे, यथार्थ यथार्थ, थोड़ा loudly बोलो.
So it will reduce the money supply. Am I audible now?
Yeah, you are audible. Go ahead.
So it will reduce the money supply since banks will have to keep money with themselves as a part of their reserves.
With themselves or with RBI?
Sorry, with RBI.
With RBI. So if the CRR will increase, then more money has to be kept with RBI. So the availability of the money with the commercial banks also will be relatively less. So that will induce them to reduce the loan supply of the loans to the system. That is basically the another factor which is affecting this aggregate money supply within the economy. So one thing we have discussed about open market operations, then we have discussed about bank rate, then you said about cash reserve ratio. Now you tell me how SLR will affect the money supply. Priyansa, you said about SLR, right? Or who was telling
Sir.
SLR? Yes. Priyansa, tell me how SLR will affect the money supply. What is SLR first?
Sir, if SLR will increase, then money supply will decrease.
What is SLR? You tell me.
Sir, it is the minimum cash, like minimum cash requirement that the banks has to have to keep with themselves for withdrawal purposes.
No. It is not SLR. SLR is nothing related to keeping the money with the bank for the withdrawal purposes. SLR is something else. RBI cannot decide that how the bank will keep that money for the withdrawal purposes. That varies from one bank to another bank depending upon the different situations. So what exactly SLR is? It is not for the withdrawal rate. SLR is basically...
Sir, like it is the minimum liquid cash or like the gold and these assets which the bank has to keep with them on.
No. It is basically from the investment perspective. What are those liquid assets or liquid kind of investment alternatives what the bank has to always invest, right? It is basically what basically we can call it that if you see it is the percentage of the total deposits the bank has to invest in the government bonds and other approved securities. You know what is the reason? The reason is that SLR is kind of precautionary motive. The basic objective of the SLR is the RBI always wants to play with the SLR to ensure that the banks should be, the probability of liquidation of the bank will be relatively less. So that means if the bank will invest certain money in the government securities and other government approved securities, then the probability of default against that particular investment is not there. So by that, if there is a requirement, the bank can always liquidate those assets and get the money immediately. Are you getting my point? Is it clear or not?
Yes, sir, it's clear.
Yeah. So the SLR rate is let 14, 15, 16% with below 20%. But if you observe the bank's balance sheet, banks invest more than 30% in SLR instruments because these are the safe investment alternatives for the banks. The return is relatively less, but there is a guaranteed return. The return is relatively less and there is a guaranteed return. Even if RBI has told them to keep this much percentage of the total deposits should be invested in SLR, but they, if you observe the practical balance sheet of the commercial banks, they always basically try to invest more in the SLR instruments. That is the general trend in India. So the return is relatively less in comparison to the investments in the stock market and other markets, but the probability of default is not there. So if there is any issue, then they can always go and liquidate that particular asset and get the money to fulfill their requirements. So that's why there are three objectives. One is to restrict the expansion of the bank credit, to increase the bank's investment in government securities, and the last objective, if you see, to ensure the solvency of the banks. To ensure the solvency of the banks. The solvency means basically the banks should be solvent every time. That means the probability of failure or the probability of liquidation of the particular bank will be relatively less. So that's why the SLR instrument was there within the system. This is nothing related to the keeping the money for the withdrawal purposes. That is different. After fulfilling your CRR, bank first fulfill the CRR. Once they fulfill the CRR, then they will fulfill the SLR. Then after fulfilling the SLR, some of the money they will use it for their what we call it the transaction purposes, short-term requirement purposes, and some of the money they will invest in different other activities, and some of the money they will give it as the loan. So this is the way the broad classification of the deposits or broad use of the deposits always happen with the commercial bank. Okay, there are some other instruments which are not that way used in today's context, but you just keep in the mind the direct credit allocation and credit. This instrument basically controls the distribution or allocation of the credit among the different sectors. Only India, we have one allocation we have made, that is basically your priority sector lending. So around 30 to 40% of the total loans what the banks give, that has to be given to the priority sector. And because of this restricts the drawing power of the borrowers under the cash credit limits. And that's why there is a certain prescribed credit deposit ratio has to be maintained. And that credit deposit ratio is different across the regions, like rural and urban kind of setup. Then another instrument also, which is not that way used frequently, that is called the selective credit control. So they are used to reduce the supply of the credit in certain directions and to encourage it in the desired directions. That is basically not that way used. In certain sectors would not always get the loan by that. Maybe it is profitable for the banks, but it is not. It is controlled by RBI not to go for that, because that sometimes basically go for the coding and other kind of activities. So because of this, generally the selective credit controls were there, or it is not basically one of the effective instrument which is used by the RBI. So these are also only were there, but it is again not that way very effective. One is that the credit proposal of the some amount of money and above in case of working capital, or 2 crore and above in case of term loans, has to be submitted to the RBI for the post-sanction scrutiny. If somebody wants to get a loan of 2 crore and above, or the particular kind of corporates or the kind of companies want 5 crore and above loan for the short-term requirements, then prior approval from the RBI is required. Then we have the process of credit planning. The bank has instructed the RBI has instructed all the banks to go for a realistic annual credit budget, which will give you the estimate of the volume of the growth of the deposits and other sources. By that, they can have a plan, contingency plan, to what we can say that how to control this money supply in the future. Moral suasion, this is also a theoretical concept. It basically the kind of persuasion to the different stakeholders, particularly the discussion or the writing letters between RBI and the banks about the trends in the economy in general, and in money, credit, and finance in particular, and about the measures which ought to be taken from time to time in the light of the national objectives, or to increase the growth rate or maintain the price stability. So these are all the direct instruments what basically we talk about. But in India, if you see, mostly the effective instruments are to some extent are used. These are the instruments like your, in today's context, the concept has been completely changed, but the major instruments are basically your open market operations, your cash reserve ratio, you have the SLR, you have the bank rate and all these things. Particularly the different interest rates which are used to control the money supply. But in current context, we have a setup, or we have a kind of process, what we call it the liquidity adjustment facility, which is now currently followed by RBI. So that is the most important thing what the RBI is following in today's context to control the money supply. So the liquidity adjustment facility means It basically a liquidity management process. And this management or this money supply is basically done from the day-to-day basis. So in that process, the repo rate and reverse repo rate comes into the picture. So effectively now if you see, the most used instrument or most effective instrument to control the money supply is the is the repo and reverse repo rate. Okay. So the repo rate, already you know that it is the instrument for borrowing funds by selling securities with an agreement to repurchase the said securities on a mutually agreed future date at an agreed price, which includes interest for the funds which has been borrowed. And reverse repo rate is just the reverse, which is the lending of the funds against buying of the securities with an agreement to resell the said securities on a mutually agreed future date at an agreed price, which includes the interest for the funds which are lent. And these interest rates like reverse repo and repo, which are the policy rates, what we call it. RBI uses repo rate as the policy rate. And this policy rate, which is a part of the LF, generally it is fixed by the Reserve Bank of India from time to time. So now the whole monetary policy of the Reserve Bank of India is working through this liquidity adjustment facility. The liquidity adjustment facility is the only operating procedure or only process through which the whole money supply in the economy is controlled by the RBI. So what basically happens in that particular context, if you see the effectiveness of the bank rate is not there. The bank rate is not nowadays popularly used by RBI frequently to control the money supply. But before I go to discuss about the operating procedure of the monetary policy, how exactly it happens, what is the mechanism, what the RBI basically follows, let me ask you certain kind of channels which are basically used to or what we can say that the monetary transmission channels. So how the monetary transmission channel works? How many channels are there? Can you tell me? Anybody has the idea about the monetary transmission channel? Yes? सुने हो concept? Yes? Am I audible?
Yes, sir.
Yes,
You're
sir.
audible.
Tell me, what are those different channels through which money is basically transmitted, or increase and decrease in money supply will transmit to the growth, or the increase and decrease in the output in the economy?
The interest rate.
Interest rate, yes. Anything else? How this interest rate
Sir,
channel works?
exchange.
How the interest rate channel works? Yes. Let you have increased the interest rate. Then what will happen? If interest rate will increase, then the money supply will decline, right? Yeah, Nidhi?
Yes, sir.
If money supply will decline, then that will lead to, why the money supply will decline?
So demand for loans by the firms will go
Okay.
down.
The cost of capital will increase. So if the cost of capital will increase, then demand for loan will go down. If the demand for loan will go down, then what will happen? That the investment will go down, which will basically decline this aggregate demand, right? So if aggregate demand will decline, then automatically the output will decline. So that is called the interest rate channel. What are the other channels? Yes. Can we use exchange rate channel also? Can we use a exchange rate channel through this interest rate? If anybody can explain any reason, usko chocolate milega. How the exchange rate channel will work? कौन बोलेगा? सिद्धार्थ? Akshat?
Yes, sir.
How the exchange rate channel will work? You can guess, Ray, no problem.
Sir, exchange rate affects the foreign investments.
You tell me the channel. For example, if I tell interest rate has increased, so the money supply will decline, obviously. So does the increase in interest rate will have the impact on the exchange rate? Yes or no? If domestic interest rate will rise, then how it will affect the exchange rate?
So it will depreciate the local currency.
Right. So if it will depreciate the local currency, it will depreciate the local currency or appreciate the local currency?
Sir, appreciate the local currency.
It will appreciate the local currency.
Yes, sir.
Okay, good.
Yes, it will depreciate.
How it will depreciate?
Oh, I'm sorry, sir. Yeah, it will appreciate.
It will appreciate the local currency. If it will appreciate the local currency, then your net export will increase or decrease?
Decrease.
Net export will decrease. If your net export will decrease, then your output will increase or decrease?
Decrease.
Decrease. So increase in interest rate will basically have the impact on exchange rate. So the exchange rate will get affected, then your export performance gets affected. If export performance gets affected, then your output also gets affected. So that is called the exchange rate channel. So if I tell you,
could you
yes,
explain it again? I mean, something was appreciating. I did not understand what was appreciating and why it was appreciating.
कौन पूछ रहे हो रे?
Sir,
Who is
I'm
asking?
Karthik. I'm Karthik.
Ravi.
I'm Karthik.
Ravi. Karthik.
Sir,
Tell me, explain. Priyansa, you tell why this exchange rate will appreciate of the local currency?
Sir, if the interest rate increases, then returns on the investment will increase, like the domestic investments. So, if like the domestic returns on domestic investment are increasing, then the value of the current domestic currency will increase in with respect to foreign currency, and it will also attract foreign investments.
Foreign investment. Let me anyway simplified way let me explain. For example, your domestic interest rate will rise. If the interest rate will rise in India, then what will happen? That one point what she has said, that is one argument. Other argument also you can say, other channel also you can also think. Let the domestic deposits become more attractive relative to the deposits denominated in the foreign currency. Okay, because your interest rate is higher here. So he was talking from the investment perspective. and some people from maybe the investor from US can borrow the money at a lower rate from the US market, and they can keep the money in the deposits in the Indian market as a where this interest rate is relatively higher. So that basically will lead to the rise in the volume of your local currency deposits relative to the other currency deposits. So if that will happen, then this basically will go for appreciation of the local currency. Okay, that will increase this basically value of the local currency. So because of that, there is appreciation of the local currency in that particular market. Is it clear, Ravi? Karthik?
Yes, sir. It is clear.
So then what will happen that if the local currency appreciation will be there, then obviously it will be expensive for the export from that particular country. So then finally your net export will decline. If net export will decline, then your output will decline. So that is called the exchange rate channel. So let me ask you the another channel. If I will tell you that I will consider the other kind of, already all of you know that bank deposit another channel. If the bank deposit will decline, then obviously your bank loan also will decline. If the bank loan will decline, then your investment will decline, then finally your output will decline. That is basically very much clear to all of you. Can I say if the price of the other assets will change, then it will also have the impact on the output? Let the price of the equity, price of the stock. If the price of the stock will decline, then how it will have the impact on the output?
So net exports will
Sir,
increase, sir.
what do we exactly mean
Sir,
by
output will
here?
decrease.
Output means it is the GDP rate. Always. Total growth rate of
Sir,
GDP. Yes.
Sir, if the stock prices decline, then the output should also decline.
How? What is the channel?
Sir, because if the stock prices decline, then the investments will decline.
First of all, you start with interest rate. Then let this interest rate has declined. Okay. So if the interest rate will decline, or let there is a rise in interest rate. So if there is a rise in interest rate, then people will more invest in equity, or they will invest more in bond.
In bonds, sir.
If interest rate will increase, then people will invest more in bond or not?
No, sir, equity, sir.
Why? Interest rate ज़्यादा है तो people will invest in more bonds or more in equity?
Sir, more in bonds.
Why?
Sir, because the risk in bonds is less, and if the interest rates is high, then you'll get a higher interest on those bonds.
अरे नहीं तुमको बॉन्ड खरीदना है मार्केट से, तुम जो बॉन्ड में इन्वेस्ट करोगे बॉन्ड से मार्केट से खरीदना है, तो if interest rate is high, then the bond price will be low, or it will be high?
Low. Sir, it will be low.
It will be low. So if your bond price is low, then you will be ready to invest more in bonds in comparison to equity. Yes or no?
Yes, sir. Yes.
So the demand for bond investment will go up if this interest rate is high. So if you assume that bond investment and equity investment are substitute to each other, then what will happen that the demand for equity will go down. If the demand for equity will go down, then the price of equity will go down. If the price of equity will go down, then obviously it will have the impact on the relative impact on the investments, right? So then finally your output or the aggregate output of the economy may gets affected by that also. So that is basically another channel what we can consider. Because the price of equity goes down, then automatically your wealth or the total income will goes down. If total income goes down, then it will have the impact on the consumption also. So if the consumption will go down, then the investment will go down. If investment will go down, then finally your output also is going to be down. So that is called the asset price channel. This bond price and other price, which is basically will have the change in the bond price, change in the stock price, will have the impact on the we can say that output whenever there is a change in the interest rate within the system. So there are many other channels, but you just keep these things in the mind that these are the things which are quite important from the monetary policy effectiveness or monetary transmission mechanism, what generally we call it. So whenever we talk about this operating procedures of the monetary policy through this liquidity adjustment, what basically RBI wanted to do. If you see this, the RBI always wants to maintain a corridor. The RBI basically wanted to maintain a corridor. The corridor is like this. So there is a ceiling, there is a base, and there is an intermediary target. So your base is basically reverse repo rate, and your ceiling is, there is a rate called the marginal standing facility rate, and between this we have the repo rate, and RBI always assumes that the overnight call money rate, which is the rate which is prevailed across these banks, the call money rate should be always below this marginal standing facility rate. It should move below this marginal standing facility rate. So that is the corridor basically they maintain. Time to time the corridor range basically changes. But apart from this, my question is that what is the logic of having this kind of corridor? What is the logic of having this kind of corridor? Tell me. Why always RBI thinks that this kind of corridor should be maintained? The reverse repo rate should be below this repo rate. Okay. And your what we can call this the call money rate should always below this marginal standing facility rate. What is the repo rate now? Can you tell me what is the repo rate? Repo rate is 4%, and the reverse repo rate is 3.35%, and the marginal standing facility rate is 4.25%. The marginal standing facility rate is 4.25%. Okay. So now the question here is that why this corridor? If this corridor will be maintained, then why are you thinking that? And generally this call money rate, if you observe average call money rate, this is around 3.4%. 3.4%, which is prevailed in today's context. So my question is that why? What is the basic objective? This write-off you forget, because this was the policy before, but now this is changed. It is free now. But my question is, you look at this figure. This base rate is the reverse repo rate. Middle, there is the repo rate, and we are ensuring that the call money rate will vary within that particular range, and above we have the marginal standing facility rate. What is the basic objective of having this corridor? If this corridor will be maintained, what is the benefit for the economy? Or why
Sir,
RBI
RBI
wanted to?
will
Yes.
gain some money in this.
Yes.
RBI might gain some money in this. Like it
RBI
is.
will gain from this. How RBI will gain there? My question is that why actually this corridor should be maintained? What is the benefit?
So if reverse repo is less than repo, then I guess banks would be inclined. Sorry. If reverse repo was to be greater than banks would deposit the money to RBI and gain more interest rate, right? More
No,
return.
reverse repo anyway cannot be more than the repo because reverse repo rate is fixed by RBI.
Yes, so that is why it is less than repo.
That is fine. But my question is that why you are ensuring that the call money rate should always below this marginal standing facility rate? The marginal standing facility rate is the rate at which the commercial banks also can borrow the money from the RBI after their quota for this repo rate borrowings will be over. A certain amount of money they can borrow from RBI through repo operations. But if that particular amount is not sufficient, then they can go and borrow this extra money using this marginal standing facility rate. Are you getting my point? Is it clear?
Yes, sir.
Yes or no? Kamaljit? Kamaljit?
Yes, I got your point.
So you are entitled to borrow 50 crore through this repo, but you need 60 crore. So if you need extra 10 crore, that can be borrowed through this marginal standing facility rate, which rate is higher than the repo rate. But the question here is that why always we assume that the call money rate is the rate at which one bank borrows from another bank. One commercial bank can borrow from another commercial bank in a call money market. We'll discuss about more that whenever we start about the call money market, but I'm just giving you the idea. The call money rate is the rate at which it is the interbank lending rate. It is one bank borrows from the another bank. That is called the call money rate. So my question is that if the call money rate will be below this marginal standing facility rate, what objective of the RBI will be fulfilled? Yes. Adrija?
So, still thinking.
Thinking.
Yes.
Sir, it will be more difficult to repay it. I mean, it will be more expensive in order to repay if it exceeds certain limit.
What is the benefit? RBI को फायदा क्या होगा? What is the benefit for the economy?
So RBI would be taking less risks, I guess.
Will be
It would
taking
be
less
exposed
risk.
to less risk, yeah. In this case.
Okay. Any other argument? Nitin?
Yes, sir.
You have anything in your mind? Are you getting?
To some extent, yes, sir. I'll have to read up on this again.
Okay. Ayush? Ayush?
Sir, I didn't get your question clearly. Can you repeat?
My question is that why RBI always ensures that the call money rate should be below the marginal standing facility rate?
So even after the repo rate quota is crossed, if the bank needs money, then like someone else said that there must be some risk involved in it, and hence they want the other bank to lend it so that the RBI does not have to bear the losses.
RBI does not have to.
Bear any kind of consequences of the reason why they have to borrow that amount of money.
So that means, are you telling that if beyond this repo quota, if this any particular bank needs more money, then they can borrow from the other bank, right? Instead of going to RBI.
Yes, sir.
So if they will borrow from the other bank, then what is the benefits? One, you said that RBI does not have to bear the extra risk, but is it the only reason? Is there any other reason? You see, the other reason is that whenever you are borrowing the money from RBI, the extra money what you get it from the RBI, that is the addition to the existing system, existing money supply, which is already there in the economy. Let the total money was available in the economy was 500 crore. If additional 10 crore you have received from the RBI, then total money supply will become 510 crore. But if you are borrowing from the other bank, some bank have the surplus, some bank have the deficit, then what will happen that the total money supply in the economy, that 500 crore will remain intact. This will not be any extra addition to this existing money supply which is there in the system. So because of that, the total money supply will not get affected. If the total money supply will not get affected, then it will not have the impact on the price stability and the other indicators of the economy. So in a particular time period, particular kind of time gap, the RBI ensures that the price stability should be maintained. So to maintain the price stability, they will ensure that the corridor should be maintained. But for example, if the call money rate will be higher than this marginal standing facility rate, because call money rate is not in the control of RBI, call money rate is the control of the demand supply forces in the interbank market. So if this call money rate will be higher than the marginal standing facility rate, then what this commercial bank who needs the money, they will do. So instead of going to call money market to borrow the money, they can get the money from the RBI, what additional money they want. If they will borrow from RBI, then that money will be added to the system. If that money will be added to the system, then automatically it will increase the money supply. If it will increase the money supply, then this will have the impact on inflation and the other kind of macroeconomic indicators within this setup. So if this corridor will be maintained, or if this call money rate will be below this marginal standing facility rate, then what will happen that the total money supply will not be getting affected, because only market will take care of their own requirements, and automatically your price stability will be intact. Is it clear? Yes or no?
Yes, sir.
Yes, sir.
Priyansa, you could get?
Sir, what if more number of people borrow from RBI? Even in that case, the total amount of money that will be circulating will increase, right?
People cannot borrow from RBI. Only
I mean,
bank
other
can borrow
banks,
from
if there are,
RBI.
if there are more banks that are borrowing from RBI,
then it will
then
increase the
even
money
in
supply.
that case, okay.
Yes,
So
it will
even in
increase
that
the
case,
money
the money
supply.
supply will be increasing, right? I mean, these two
Obviously,
effects are same. I mean, whether a particular bank is borrowing at a higher rate, or there are many banks that are borrowing at a lower rate, they create a same impact, right?
no. It is borrowing from RBI rate. The policy rates are fixed. But let State Bank of India has surplus money. Punjab National Bank needs some money in a particular day, overnight basis. So if the State Bank of India is basically offering a lower rate, what the RBI is offering at a part of the MCL, this marginal standing facility rate, then the PNB will borrow from State Bank of India. Why they will go to RBI to borrow the money? Karthik, are you getting
Yes,
my
sir.
point?
I got it. I got it. Yes.
So in that case, the total money which was circulating in the economy, that will intact. The total money supply will not be getting affected. So to maintain the price stability, this monetary policy corridor, what basically RBI wanted to maintain, if the corridor is not maintained, for some reason, the demand supply forces which prevailed in the money market, by that the call money rate has become more than the marginal standing facility rate. So that time the banks, what they will do, so instead of borrowing the money from the call money market or from other banks, they will prefer to borrow the money from RBI, which is cheaper. So in that case, the price stability will get affected, and because the total money supply will get affected. If total money supply gets affected, then the price stability will get affected. Then finally, this objective of the monetary policy to control the price stability may not be maintained. So because of this, generally, RBI always ensures that the corridor has to be maintained. So that is called the operating procedure of the monetary policy. And that is basically done through the management of the liquidity. So now the target or the objective of the monetary policy is always based upon a short-term adjustments, and that short-term adjustments are made through the liquidity adjustment facility. Okay, so this is what basically what always we mean whenever we talk about the operating procedures. Okay, we can stop here. There are other issues we may not have enough time to discuss that. We'll discuss it in the next class. Okay.
Sir,